Good morning, everybody. Welcome back to the show. My name is Luke, and this is the OptionBomb. And today we are talking about SanDisk. Man, we are going to be looking at its astronomical rise from the spinoff 16 months ago, going from 36 bucks all the way up to over $2,000. We're then going to be taking a look at the fundamentals of the company to see if there's any more room left to run in this stock. And finally, we are going to be pulling up the option chain to see if there's any sort of short-term trade we can put on to make some money in this name. But for now, guys, let's talk SanDisk. Because a year ago, almost nobody wanted this stock. And today, it is one of the best performing stocks in the market. Ticker SNDK. This is the stock that spun out of Western Digital at roughly 36 bucks a share back in February of 2025. And today, it's trading near $2,000, and it cracked $2,000 today. A move of more than 5,000%. So if you had put 10,000 bucks into the spinoff, you'd be sitting on more than $500,000 today. And now normally, when a stock goes up 5,000%, the conversation is over. You missed it. Move on. Find the next trade. But that's not what Wall Street is saying. Bank of America still has a $2,100 price target on this stock, and analysts are modeling record earnings. Institutional investors continue building positions. And that's what makes this interesting. Because the question isn't whether SanDisk has been a great stock. It has, obviously, right? Look at the chart, and let's pull up the chart quickly, right? Let's just take a little side note here and pull up the chart so we can see what we're actually dealing with. Here's the chart of SanDisk. Way back here, this is around 36, 40 bucks a share back in 2025, and this thing just kept flying. I mean, look at right here. This is 290 bucks, 300 bucks a share. So to go from 36 to 300, you'd be happy. But we're talking all the way up to 2,000, and right now we're at $2,092, and it's June 15th. This is an absolute insane move. So the question we're going to ask ourselves today, right, is whether the market is still underestimating what's happening underneath the hood of this stock. So here we go. So most investors, right, we look at a 5,000% gain on a chart and assume the story is over. But Wall Street is looking somewhere else. They are looking at the actual earnings, the demand, and the numbers. And the numbers, guys, are absurd. In Q3 2026, SanDisk reported revenue of $5.95 billion. That is up 97% sequentially. That's not year over year. That is quarter over quarter. Gross margins expanded from 50.9% to 78.4%. And data center revenue jumped 233%. So for a storage company, those numbers are almost unheard of. We are talking software level margins on storage hardware. And management says the next quarter could be even bigger. The Q4 guidance calls for revenue between $7.75 and $8.25 billion. EPS between 30 and 33 per share for one quarter. That's why analysts aren't focused on what the stock did. You can't look at where a stock's been. We can only focus on where it's going. And they're focused on what the business is doing. And that's where the story gets interesting. Because it's not really a storage story anymore. It is an AI infrastructure story. Because for the last 2 years, investors have been obsessed with one side of AI. That's the compute. NVIDIA, GPUs, training clusters, processing power. Right? These are all important. But AI has another requirement. Storage. Every data set, every training run, every checkpoint, every model output, and every inference, it all has to live somewhere. And increasingly, that somewhere is high performance NAND flash storage. That is exactly what SanDisk sells. So while the market was chasing GPU shortages, NAND quietly became one of the most constrained parts of the infrastructure stack. AI demand exploded, but supply stayed tight. And SanDisk suddenly had pricing power it hadn't seen in years. You want to run your training cluster and you need our storage devices? You're going to have to pay up, buddy. Right? That is why the margins exploded, because these training clusters needed it. And if they didn't have it, these multi-million dollar projects sit idle. So that's why earnings exploded. And that's why the stock exploded. The market wasn't buying a storage company. It was buying a linchpin to their AI data centers, and they were buying exposure to one of the least appreciated bottlenecks in the AI infrastructure. So here's the part of the story, guys, that I think matters the most. And it's the part that separates this from a normal semiconductor cycle. SanDisk is no longer operating entirely in the spot market. Management has been signaling what they call new business model agreements, or NBM contracts. These are multi-year customer agreements that lock in revenue visibility. 5 agreements have already been signed. 3 include minimum contractual revenue of $42 billion. Combined financial guarantees exceed $11 billion. Customers have already provided more than $400 million in prepayments, and more than 1/3 of fiscal 2027 revenue is already committed. Think about that. Historically, guys, NAND producers lived and died by commodity pricing. And now SanDisk is converting portions of its business into contracted revenue streams. That's a fundamentally different company than the one that spun off from Western Digital. And the market is still trying to figure out how to value this thing. Bank of America currently models fiscal 2027 revenue of roughly $44 billion. Fiscal 2027 earnings around 188 per share. And at today's stock price, that's roughly 10x forward earnings. Not exactly what most people imagine when they hear about a stock that's up 5,000%. So guys, why did this thing exist at 36 bucks in the first place? If it took 16 months to go up 5,000% and be at over $2,000 a share, why 36? Because understanding how this totally happened, right, it matters. SanDisk isn't new. The company was founded in 1988. It invented the compact flash card, the SD card, the USB flash drive. Western Digital acquired it in 2016 for $19 billion. And their idea was simple. Combine hard drives and flash storage. Become a storage giant. Instead, the business became valuation anchors on each other. Hard drives were mature. Flash was becoming strategic. And eventually activists pushed for separation. The spinoff happened in February of 2025. Investors treated SanDisk like the unwanted child of the divorce. And the stock opened around 36 bucks. But then AI changed everything. And the stock is where it is now. So let's talk about what could go wrong here, because there are legitimate risks to this AI trade. And risk number 1 is NAND cycles are vicious. Supply shortages never last forever. And eventually capacity comes online. And when it does, pricing falls, margins compress, and earnings come down. The bull case says new supply doesn't materially arrive until 2028 or 2029. But the bear case says that is wrong. Risk number 2, guys, customer concentration. When data center revenue grows 233% in a quarter, a small number of customers matter a lot. If hyperscaler spending slows, results can change quickly. And risk number 3, valuation expectations. The stock has already priced in enormous success. And if the August 12th earnings disappoint, the reaction could be violent to the downside. And finally, risk number 4 is insider selling. Executives have been net sellers over the last year. And why wouldn't they? Why wouldn't they lock in their profit? It doesn't necessarily mean they're bearish, but it's definitely worth watching how many shares they dump into the open market. So now that we've kind of discussed SanDisk as a whole, let's pull up the chart and the option chain and see if there's anything we can do in the short term to make some money. So here we've got the chart up, and we can see the monster run that we talked about earlier, going from 36 bucks all the way to 2,119. And guys, for me, if I'm being completely honest, at a $2,000 stock, we are talking probably using up between $100,000 and $150,000 worth of buying power. And I don't know if I'm completely comfortable with that. So for me, naked options are off the table, right? I mean, I can't sell. I just can't do it. The risk reward, the risk is too big. I don't currently own 100 shares of SanDisk. I mean, if you do own 100 shares and you're sitting on them, yeah, for sure, go sell some covered calls, right? Maybe you think this is good, as high as it's going to be, and you want to take a little breather. You could sell your shares and sell a put, collect some premium. I don't know if I necessarily recommend that, but that is an option. So if I'm going to do anything in this name, it's probably going to be something defined risk, because I don't really have enough capital to buy 100 shares right now. And this thing could go to 3,000 bucks for all I know, and I can't risk that type of I can't make that type of risky trade with a naked call, short call to the upside. So let's pull open TastyTrade and look at the option chain and see if there's anything we can do, or if it's just kind of messing with the stock with this type of price tag is just too much for us. So if I pull open SanDisk, I'm going to stay in July, because if I go to August 21st, I'm going over earnings, and I don't want to do that. So July 17th, and I'm looking for something defined risk. I'm going to put on a put vertical because I am still bullish. And man, guys, these are, first off, the IV is 79.6, so that's really, really high. That's another reason why we don't want to buy options. So we could get smoked with the IV. As far as a vertical spread, I'm going all the way down. This orange bar in TastyTrade is the expected move. I want to be outside the expected move. So let's go right outside the expected move, 1560, and let's see what we can get here. 1520. We're collecting $7 to risk 4,000. Collecting $5 to risk 3,000. That's still not good, guys. Usually I like to collect 1/3 the width of the strikes on this, and we are far from that. This needs to be upwards of $10 in order to make it worth risking anything. So guys, looking right now, because we're messing with the $2,000 stock that has an extremely elevated IV, I'm not seeing the type of trades that I typically like and that typically give. So I think that I'm going to move on from this one and not put a trade on SanDisk right now. So to wrap this up, SanDisk went from an unwanted spinoff at 36 bucks to nearly 2,000 in 16 months. And the bull case, straightforward. AI storage demand, contracted revenue, software-like margins, and NAND shortage that may persist into 2027. The bear case is straightforward too. NAND cycles always turn. Valuations eventually matter, and expectations are now extremely high. So the question isn't whether SanDisk has been an incredible stock, because it has. Anything up 5,000% in 16 months is incredible. The question now is whether there is still money to be made. And more importantly, how do you structure a trade if you're wrong? And right now, guys, with something that's moved this far, this fast, I am not going to risk being wrong. So if you enjoyed this breakdown, make sure you hit like, hit subscribe, and let me know down in the comments. Is SanDisk still early? Did you get in on the spinoff and have participated in the 5,000% upside? Or are we looking at the top of one of the greatest semiconductor runs ever? Let me know down in the comments. This is Luke with the Option Bomb, and I'll see you in the next one.